In 2022 and 2023, global central banks accumulated over 2,000 tons of gold, by far the largest two-year surge since 1950, the 173rd year since then. Remarkably, this momentum persists. In the first 3 quarters of 2024 alone, they amassed an additional 1,250 tons, putting the total on track to exceed 1,000 tons for the full year. Among those accumulating this gold are prominent institutions such as the People's Bank of China, the Reserve Bank of India, the Central Bank of Russia, Poland's National Bank, Turkey's Central Bank, Singapore, and the Czech Republic. Even nations you've likely never heard of are stockpiling gold, as if it's the final safeguard against imminent collapse. What should truly alarm you is this: central banks are not retail investors driven by emotion or FOMO. They do not act impulsively upon viral videos or rising prices. Their decisions are backed by access to classified intelligence, deep analyses of historical currency failures, data on global capital movements, trade settlements, debt levels, and geopolitical threats, none of which are publicly available. They have foreign intelligence agencies providing covert insights into other countries' strategic plans. When such powerful entities simultaneously amass gold, it signals more than diversification. It indicates a careful, coordinated effort to prepare for what's coming. And what exactly are they suspecting? The imminent breakdown of the dollar and the erasure of $37 trillion of debt through the oldest financial stratagem, currency devaluation via gold revaluation. This very tactic, employed in 1933, is set to unfold again in real time. In this analysis, I will reveal what central banks perceive that you do not, the intelligence they access, the timeline they're following, and the precise mechanisms they're deploying as they position themselves for the greatest wealth transfer in modern history. Most critically, I will tell you what you must do now, before it's too late. Because once this process is underway, with gold revalued and the dollar collapsing, there's no turning back. You will be either aligned with the central banks or caught in the fallout, holding devalued dollars while wealth evaporates. Let's begin with the stark numbers, as the scale of this development is unprecedented. According to the World Gold Council, central banks purchased approximately 1,036 tons of gold in 2022, another 1,037 tons in 2023, and by the third quarter of 2024, they acquired nearly 789 tons, an amount that, when combined with likely fourth-quarter purchases, will surpass 1,000 tons once again. This marks 3 consecutive years of such monumental buying, a feat previous records only glimpsed in 1958, when they bought around 656 tons, and before that, in 1,950, when the scale of buying was comparable. Clearly, we are navigating uncharted territory in the history of official gold accumulation. But it is not only the volume that is staggering. It is also the identity of the buyers and their motivations. China's central bank alone added 62 tons in November 2023, reporting continuous acquisitions across 18 months until May 2024, after which it ceased reporting its buying activity, probably to conceal the true extent of its accumulation. Most analysts estimate that China has accumulated between 300 and 500 tons over the past 2 years in official reserves, but that is only the tip of the iceberg. Beyond what China reports, state-controlled enterprises, sovereign wealth funds, and other financial entities are quietly buying gold without transparency. When the full picture is assembled, estimates suggest that China has amassed between 1,000 and 2,000 tons since 2022, and their buying spree shows no signs of stopping. Why such aggressive accumulation? Because China foresees what's approaching, the inevitable collapse of the dollar and the pivotal role gold will play as the ultimate reserve currency. Russia has already purchased 330 tons in 2022, becoming the largest buyer that year, and it has continued adding to its reserves through 2023 and 2024 despite relentless sanctions, an indication they are preparing for a new financial reality. Consider this. In 2022, Russia's assets frozen by Western sanctions totaled $300 billion, an entire tranche seized overnight. Now, with over $1 trillion in U.S. treasuries held by China alone, it is evident that nations are learning the lesson. Assets and dollars are vulnerable to political aggression. Russia's gold holdings now amount to over 2,333 tons, roughly a quarter of their total reserves, the highest percentage of gold holdings among major economies. For comparison, the United States officially reports a gold reserve comprising about 23% of its holdings. Notably, Russia's proportion of gold is even higher, a reflection of intentional, strategic preparation rooted in their historical experience with the Soviet collapse and the worthlessness of their currency in the 1990s. They are not buying gold solely for its price appreciation, but to safeguard their wealth in a world where the dollar's dominance is waning and the currency's sovereignty is under threat. India exemplifies another strategic player. The Reserve Bank of India has steadily increased its reserves, adding 33 tons in 2022 and 41 tons in 2023, with ongoing quarterly purchases, albeit gradually, in order to build a significant gold stockpile. Today, India holds approximately 841 tons officially. Yet, what many do not realize is that Indian households own more gold than the government and central bank combined, estimated at between 25,000 and 30,000 tons, more than any other country's official holdings. This cultural and historical familiarity with gold as a safe haven during currency devaluations informs India's ongoing accumulation as they prepare for systemic financial crises. Poland, a smaller yet increasingly strategic actor, acquired 130 tons in 2022 and again in 2023, boosting its holdings from approximately 229 tons in 2021 to over 359 tons by 2023, a 75% increase in just 2 years. Central Bank Governor Adam Glański openly states that gold is the ultimate safe asset, signaling Poland's deliberate positioning for a more unstable global monetary system, explicitly acknowledging that a decline or collapse of the dollar is anticipated. Turkey, battling ongoing currency crises, added 160 tons in 2023, and countries like Singapore continue to quietly amass reserves, guided by sophisticated financial strategies. They all share a common purpose: to prepare for the same anticipated event, an end to dollar dominance, the collapse of the current monetary system, and the transition to a new, gold-backed regime. The emerging system may involve a digital currency backed by a basket of currencies or precious metals, possibly managed by an international institution like the IMF, but it will revolve around gold. This new system's foundation will depend on a reserve of tangible gold held by participating nations, facilitating trade without reliance on the dollar or Western financial infrastructure. The implications are profound. The existing petrodollar system, established in 1974, hinges on Saudi Arabia pricing oil exclusively in dollars in exchange for American military protection. As prominent countries, including Saudi Arabia itself, begin settling energy transactions in yuan, rubles, or other currencies, demand for dollars will diminish. Recent shifts, such as Saudi Arabia's first oil sale to China payable in yuan, are unmistakable signs of cracks forming in the dollar's hegemony. Concurrently, initiatives across Asia and Latin America aim to establish regional payment systems circumventing the dollar, accelerating the decline of U.S. currency dominance. This is why central banks are focused on gold acquisition. They are positioning for the launch of a gold-backed currency, likely by 2025 or 2026, that will challenge the dollar. When such a currency becomes accepted for cross-border trade, nations dissatisfied with U.S. financial policies will naturally gravitate toward it. This transition will be swift once the new system is in place, and the consequences for the dollar and U.S. debt will be catastrophic. The mechanism behind this collapse is sophisticated but rooted in historical precedent: the deliberate devaluation of currency through gold revaluation. The United States currently owes $37 trillion, an amount that cannot be repaid through conventional means, such as taxation or economic growth. With a debt-to-GDP ratio surpassing 130%, the only viable solution is currency debasement. To execute this, the U.S. might revalue its gold reserves, currently valued at a fraction of their real worth, triggering a rapid devaluation of the dollar and a surge in gold's price. For example, the U.S. holds about 8,133 tons of gold, officially valued at just $42 per ounce, an appraisal stemming from 1973. At current market prices of around $2,700 per ounce, this reserve is worth roughly $75 billion. Yet on the books, it is valued at only $11 billion. If the government simply revalued gold to, say, $20,000 an ounce, the gold's apparent value would jump to over $5 trillion, raising the backing of the dollar by up to 25% of the money supply. More critically, this revaluation would devalue the dollar by approximately 87% relative to gold, collapsing its purchasing power and rendering dollars held by the public and creditors effectively worthless. Meanwhile, nations like Russia and China, which have accumulated gold at lower prices, would see their reserves multiply in value, gaining hundreds of billions or trillions of dollars, positioning themselves as the primary beneficiaries of this revaluation. Conversely, holders of dollars, whether individuals, corporations, or governments, would see their wealth eroded, as the currency they rely on crumbles in purchasing power. The strategy is historic and tested. In 1933, the U.S. faced a debt crisis fueled by the aftermath of the First World War and the Great Depression. President Franklin Roosevelt implemented gold revaluation policies that effectively devalued the dollar and inflated away debts, from a fixed gold price of $20.67 per ounce to $35. This devaluation lightened the debt burden, reduced its real value, and set the stage for post-World War II economic recovery. Yet for ordinary Americans, the fallout was severe. Those who had turned in their gold at the old price lost a significant portion of their wealth, which could not be recovered until the gold standard was finally abandoned. Today, central banks are preparing to repeat history, not through outright confiscation, but via strategic revaluation. They understand that their massive gold reserves, valued at a fraction of their true worth, are their best tool for sacrificing the dollar and easing debt burdens without causing widespread panic. The narrative will likely be spun as returning to sound money, but the real objective is devaluation, eroding dollar debt, transferring wealth to gold holders, and resetting the monetary system to serve their long-term interests. The reality is that the U.S. dollar's status as the world's reserve currency is under siege. Countries are diversifying, forming alternative trading blocs, and building reserves in gold and other assets outside the Western financial system. The framework for a new, gold-backed exchange is already underway, imminent and visible through official policies, geopolitical shifts, and the strategic accumulation of gold by central banks. When the transition occurs, the winners will be those who have prepared, holding real, tangible assets that cannot be printed or frozen, while others will be left holding devalued paper. The message is clear: the immediate future is critical. The timeline accelerates from 2025 through 2026, culminating in a global transition that could drastically revalue gold and global currencies. If you wait too long, the window of opportunity will close, and it will be impossible to recover lost wealth. The question is, will you align yourself with the smart money, the central banks, or be caught unprepared when the system resets? In the coming months, watch for key developments: central bank gold purchases, announcements of new currency regimes, shifts in energy and trade agreements, and signals from policymakers signaling systemic change. Gold's price will be your best indicator, rising above thresholds like $3,000, $4,000, and eventually skyrocketing to $20,000 per ounce will mark each stage of this transition. If you act now and position yourself appropriately, you have a genuine chance to preserve and even grow your wealth amidst the impending reset. This is not speculation. It is history repeating itself, with precise policy moves and strategic accumulation by those with the most intelligence and power. They see what is coming. The question is whether you do, too. The window to act is closing. Make your move before the tide turns completely. Their purchases aren't halted because they wish to conceal their true levels of accumulation. Most analysts estimate that China has added between 300 and 500 tons to its official reserves over the past 2 years. Yet, what remains largely unspoken is that these figures only represent China's reported holdings to the IMF. Beneath the surface, China's state-owned enterprises, the State Administration of Foreign Exchange, sovereign wealth funds, and other investment entities, none of which report to the World Gold Council, are actively buying gold as well. When totaling all sources, it's likely that China has amassed between 1,000 and 2,000 tons of gold since 2022, and their buying spree shows no signs of slowing. Why? Because China perceives the inevitable, the collapse of the dollar. When that moment arrives, the country holding the greatest amount of gold will emerge victorious. In 2022, Russia's central bank bought 330 tons of gold, making it the largest single buyer in that year. Despite being subjected to intense economic sanctions in 2023 and 2024, Russia continues its gold purchases, perhaps precisely because of those sanctions. Consider this. In 2022, Russia had $300 billion worth of dollar assets frozen by Western powers, assets they believed were secure in Western banks and securities, only to see them seized overnight. Now, imagine any other nation observing these events. China holds over $1 trillion in U.S. Treasury securities. What's to prevent the United States from freezing Chinese assets should tensions escalate over Taiwan? Nothing. The precedent has already been set. This realization has compelled every central bank worldwide to learn a critical lesson: avoid holding dollar assets that can be frozen. Instead, they're shifting to assets that the U.S. cannot touch, namely, physical gold stored in vaults in Beijing, Moscow, or New Delhi. The United States cannot freeze or seize physical gold once it's secured in these vaults. Neither can they sanction it. It remains entirely under the owner's control. Russia, for example, now officially owns 2,833 tons of gold, roughly a quarter of its total reserves, making their gold holdings the highest percentage among large economies. In comparison, the U.S. officially holds about 23% of its reserves in gold. Russia's higher exposure is a strategic choice, rooted in their awareness of the geopolitical landscape. Having lived through the Soviet Union's collapse and the devaluation of their currency in 1991, Russia has learned the importance of safeguarding reserves in assets immune to Western financial warfare. Similarly, India's central bank has persistently increased its gold holdings, 33 tons in 2022 and 41 tons in 2023, purchased quarterly, not in large sums, but steadily. Today, India's official reserves amount to 841 tons. However, most people don't realize that Indian households possess more gold than any government. Estimates suggest between 25,000 and 30,000 tons owned privately by families. This surpasses the holdings of the United States government and China combined. It's a cultural tradition passed down through generations that in times of currency devaluation, gold remains a store of enduring value. Across the globe, central banks are amassing gold at an unprecedented pace, surpassing every Western institution combined. In India, the nation's collective holdings, both public and private, exceed those of any other country. Why do they keep buying? Because they've endured the scars of currency collapses, with the rupee devalued multiple times. Indian families and their central bank understand that in times of fiat failure, gold endures. This deep-seated knowledge is rooted in cultural traditions handed down through generations, and it's now proving true once more. In Europe, Poland's central bank purchased a remarkable 130 tons of gold in 2022, followed by more in 2023. For a nation of Poland's size, this is extraordinary, raising their reserves from 229 tons in 2021 to nearly 360 tons by the end of 2023, a 57% increase in just 2 years. The governor of Poland's central bank, Adam Glapiński, openly declared that gold is the ultimate safe asset. Poland is actively preparing for a world where the global monetary system becomes less stable. Read that again. A central bank governor explicitly acknowledging their readiness for systemic instability. There's no concealment. Poland is positioning itself ahead of the inevitable dollar collapse. Meanwhile, Turkey's central bank added a staggering 160 tons in 2023. Having battled currency crises for years, with the Turkish lira collapsing against the dollar and inflation soaring past 85% in 2022, Turkey's government is unmistakably buying gold to prepare for worsening conditions. They're living through a currency breakdown in real time, and their actions reflect that reality. Singapore's monetary authority has been discreet but purposeful in accumulating gold, based on IMF data revealing significant additions. Known for managing reserves with exceptional sophistication, Singapore sees signals others miss. It's clearly preparing for the same fundamental shift. What unites these diverse actions? Every one of these central banks is getting ready for the same pivotal event: the end of dollar dominance, the collapse of the current monetary system, and the shift to a new framework. They're unsure of the exact form this new system will take. Perhaps a gold-backed currency from BRICS, possibly a basket of currencies, or special drawing rights from the IMF. Yet they are certain of one thing. It won't rely solely on the dollar anymore. In this transitional phase, gold stands as the universal asset accepted by all. Barter and currency swaps become complicated with fluctuating exchange rates. Political alliances shift, and currencies falter. But gold remains the trusted, neutral reserve that everyone recognizes and accepts. This explains why central banks are buying gold at levels unseen in 73 years. Their preparations are driven by an accelerating process, spurred on by a crucial factor most overlook: the weaponization of the dollar itself. For decades, the United States has wielded the dollar's status as a reserve currency as a strategic weapon, penalizing nations that oppose its foreign policy by freezing assets, cutting off dollar transactions, and imposing sanctions. This approach thrived when there were no alternatives, as every country depended heavily on the dollar to sustain its economy. But times are changing. Many nations have grown tired of the dollar's dominance and are actively constructing alternative financial systems, backed by something the U.S. cannot manipulate: gold. Behind the scenes, a significant shift is underway, yet mainstream media largely remains silent. The BRICS countries, Brazil, Russia, India, China, and South Africa, have been quietly developing a plan to introduce a gold-backed currency since 2022. This isn't a conspiracy theory. It's official policy crafted by governments representing roughly 40% of the world's population and about a quarter of global gross domestic product. At the August 2023 summit in Johannesburg, the group expanded, inviting 6 new members: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. Some promptly accepted, others are still deliberating, but the momentum is undeniable. What does this mean? The BRICS nations are assembling a parallel financial architecture, one that sidesteps the US dollar entirely. This system, rooted in gold reserves contributed by each member, backs a new currency designed for trade among the group. When China purchases oil from Russia, they settle in this BRICS-backed currency. When India trades commodities with Brazil, or when Saudi Arabia, if it joins, sells oil to China, transactions occur in this gold-supported medium, bypassing dollars altogether. This initiative threatens to dismantle the petrodollar system that has solidified U.S. economic power since 1974. Traditionally, Saudi Arabia agreed to price its oil exclusively in dollars, in return for military protection from the United States. Such arrangements created immense, perpetual demand for dollars, enabling the U.S. to print vast amounts without triggering immediate inflation, since global demand absorbed the excess. But if Saudi Arabia begins accepting yuan or the new BRICS-backed currency for oil exports, the petrodollar's reign crumbles. Dollar demand diminishes sharply, and the monster of inflation could surge as trillions of dollars held abroad flood back to America. And this process is already unfolding. In March of this year, Saudi Arabia concluded its first oil sale to China in yuan, not dollars, marking the first crack in the petrodollar stronghold. Russia and India are conducting trade in rubles and rupees. China and Brazil are exchanging in yuan and reals, and regional payment systems are emerging in Southeast Asia to bypass the dollar altogether. Every agreement that reduces dollar reliance edges us closer to financial upheaval. The shift signals a profound transformation in global monetary architecture, one where the U.S.'s dominance is challenged by emerging alliances centered on gold-backed currencies, leading toward the inevitable collapse of the dollar's supremacy. This is precisely why central banks are amassing gold. They're preparing for the anticipated launch of the BRICS gold-backed currency, likely in 2025 or 2026. When it emerges, it will immediately challenge the dominance of the dollar, offering nations weary of U.S. financial hegemony an alternative they will actively adopt. Let me explain how this mechanism could destabilize the dollar and wipe out U.S. debt, revealing the deep strategy behind it. Currently, the U.S. owes about $37 trillion, with a debt-to-GDP ratio soaring to 132%. The annual interest alone exceeds $1.2 trillion, more than the entire defense budget, making repayment impossible through conventional means. You can't tax your way out of such debt, nor can economic growth keep up when debt expands faster than the economy. Cutting spending won't suffice when interest payments drain 5% of GDP. The only viable option is devaluation, but simply printing more money would trigger immediate panic. Instead, a more subtle approach is required, something that appears to strengthen the dollar while secretly undermining it. This is achieved through gold revaluation. The playbook mirrors what Franklin Roosevelt employed in 1933, and it's poised to be used again. The U.S. government officially holds about 8,133 tons of gold, roughly 261 million ounces. At current market prices around $2,700 per ounce, the total gold reserves are worth about $75 billion. Yet, on the books, they're valued at just $42 per ounce, set in the 1973 statutory price. This discrepancy means the reserves are recorded as only $11 billion, not nearly $750 billion. Such a gap provides enormous room for revaluation. When the U.S. revalues its gold reserves, it can announce a partial backing of the dollar, not a full gold standard, but enough to create the illusion of sound money. While gold advocates applaud this move, it's a cleverly disguised trap. To truly back the dollar with gold, the country must hold enough gold relative to the total money supply, currently about $21 trillion in M2. With only $75 billion in gold at current prices, the backing is just a mere 3.4%, far too low to be credible. However, if the U.S. revalues gold from $21 on the books to $20,000 per ounce, their gold holdings suddenly surpass $5.2 trillion in value, about 25% of the money supply. This makes gold appear to support the dollar convincingly, allowing the government to market it as a return to sound money and portray the U.S. as a financially responsible superpower. But in reality, this strategy dramatically devalues the dollar by about 87% relative to gold, because gold's price jumps 50 times from the statutory valuation. As gold's value skyrockets, the dollar's purchasing power plummets. This means everything, food, energy, housing, becomes effectively more expensive, and the country's debt burden, denominated in dollars, is drastically reduced in real terms. The existing $37 trillion of debt effectively vanishes as the value of the dollars used to settle that debt collapses, regardless of their nominal amount. This strategy isn't theoretical, it's rooted in history. Roosevelt's 1933 move served a similar purpose, inflating away debt by revaluing gold. The government confiscated citizens' gold, revalued it from $21 per ounce to $35, an increase of nearly 70%, massively inflating reserves and eroding debt in real terms. Citizens, who had to turn in gold at the lower price, suffered a loss of purchasing power, while the government dramatically increased its gold holdings worth. Now, the same playbook is poised to be enacted once more, but on a global scale. The critical difference today is the massive buildup of gold reserves by central banks, driven by geopolitical risks, the weaponization of the dollar, and plans for a new, gold-backed currency, most notably by the BRICS nations. As these nations prepare to switch to a gold-backed system, the U.S.'s current debt and currency dominance could be irrevocably compromised. In the coming years, smart monetary moves, like gold revaluation, will reshape the financial landscape, eroding dollar value while boosting gold as the ultimate store of wealth. The question remains, will you recognize the signals and position yourself accordingly, or will you be left behind in the chaos? Here's the brilliance behind this strategy. The United States' $37 trillion debt is all expressed in dollars. Today, those dollars have lost approximately 87% of their real value. In practical terms, the true debt burden has plummeted from $37 trillion to roughly $4.8 trillion, erasing a staggering $32 trillion not by repayment, but through currency devaluation. Essentially, they have quietly confiscated $32 trillion from creditors, bondholders, savers, and dollar holders, redistributing it into their own coffers as the debt appears diminished. This is the core tactic. Central banks see this coming, and that is why they are buying gold in anticipation of the inevitable revaluation. To understand the gravity of what's happening, consider history, a playbook that has been employed before. In 1933, America was crippled by post-World War I debt and the Great Depression. The debt-to-GDP ratio was rising, deflation was ravaging the economy, banks were failing, and unemployment soared to 25%. The entire system was collapsing. President Franklin Roosevelt faced a dire situation and chose to revalue gold as a solution. In April of 1933, Roosevelt signed an executive order banning private ownership of gold, forcing citizens to surrender their gold to the government, which paid them $20.67 per ounce, the fixed official rate since the late 19th century. Most Americans complied and exchanged their gold for dollars. Then, in January of 1934, Roosevelt announced the new gold price, setting it at $35 per ounce, a 69% increase overnight. This move dramatically shifted the valuation of gold. Most of the nation's gold reserves, previously valued at about $4 billion under the old system, suddenly were worth almost $7 billion at the new rate. The government had conjured an almost $3 billion increase in value out of thin air simply through revaluation. Meanwhile, the debt the government owed, denominated in dollars, became significantly devalued relative to gold, igniting inflation. While prices and nominal wages rose, the real economic burden of debt was effectively reduced. By 1940, the debt-to-GDP ratio had fallen from 40% to 25%, not because of debt repayment, but because inflation had revalued away a large portion of the obligations. American citizens who had surrendered their gold at the old price lost 40% of their purchasing power, finding that they could not repurchase gold at the new elevated rate. Gold ownership was subsequently criminalized until 1974. Meanwhile, the government used the confiscated gold to erase debt and enrich itself. It's not just ancient history. It's a blueprint that central banks are studying and preparing to execute again. They recognize that a similar revaluation of gold will be, if not inevitable, highly probable, and they're positioning themselves accordingly. And this time, it will likely not be at just $35 per ounce. Let me reveal the three kinds of intelligence that central banks possess. Knowledge you do not, making their actions undeniable signals that should not be ignored. First, they have access to real-time capital flow data. When money shifts from one nation to another, central banks detect it instantly. They monitor foreign direct investment, portfolio movements, and track which countries are purchasing or selling U.S. treasuries. Over the past 3 years, they have observed a massive exodus from dollar-denominated assets. According to IMF figures, the dollar's share in global reserves has declined from 61% in 2020 to 58% in 2024, a modest 3-point drop over 4 years, but representing billions of dollars leaving dollar assets and moving into euros, cryptocurrencies, or gold. Central banks are reducing their dollar exposure not out of preference but necessity, acutely aware that the U.S. faces an impossible debt repayment of $37 trillion. They see devaluation looming and are repositioning before it unfolds. Second, they possess access to classified geopolitical intelligence. China's central bank knows detailed plans of China's military regarding Taiwan, the timeline, support of nations, opposing forces, and the likelihood of conflict. They understand what would happen to dollar assets in such a scenario. Similarly, the Federal Reserve has forbidden intelligence from NSA sources, and Russia's bank relies on FSB insights. These institutions see threats hidden from public view, notably the weaponization of the dollar itself. Since 2022, the U.S. has frozen $300 billion of Russian assets, a precedent signaling that any country crossing U.S. political interests risks similar asset seizures. Countries like China, India, and Saudi Arabia are acutely aware. They're moving assets, often into physical gold stored in Beijing, Moscow, or New Delhi. This gold cannot be frozen, sanctioned, or seized, offering an escape from the vulnerabilities of digital and financial assets. Third, they access superior economic data compared to what is publicly available. While the official U.S. inflation rate stands around 3.2% as of the end of 2024, central banks apply different methodologies. They analyze thousands of commodities, wholesale prices, asset valuations, and money supply growth. They understand that real inflation is significantly higher. Between February 2020 and 2022, the M2 money supply surged by 40%, money that remains in the system, eventually fueling inflation. While government reports manipulate inflation figures downward, central banks see the true picture unfold in rising asset prices and tangible goods over time. They are certain that inflation far exceeds official figures, potentially 10, 20, or even more percent, especially as future crises force even more money printing. This intelligence informs their strategic moves, preparing to safeguard their assets against the coming inflation storm. Central banks are accumulating gold because it has proven, over 5,000 years of history, to be the ultimate protector of wealth during economic upheavals caused by inflation. In 1923, Germany's hyperinflation rendered its currency worthless, but gold preserved wealth for its holders. Similarly, during Argentina's hyperinflation in the 80s, gold owners endured and retained their purchasing power. When the so-called Zimbabwe dollar was inflated to 100 trillion in the 2000s, gold still stood resilient, safeguarding value, an unbreakable pattern. These institutions buy gold because they foresee a period of severe inflation that will obliterate fiat currencies, a crisis triggered when governments are forced to issue endless money to cover unmanageable debts. They aim to position themselves ahead of this inevitable chaos. This systemic shift is not decades away. It is unfolding now and gaining momentum. The first phase, from 2024 to mid-2025, marks the last stages of accumulation. Central banks are rapidly buying gold through various methods, direct from miners, via intermediaries, futures contracts, and discreetly from other nations, maximizing their reserves before the eventual revaluation. Over the past 3 years, central banks have been consistently purchasing more than 1,000 tons annually, currently spending around $86 billion each year on gold at its present price of roughly $2,700 per ounce. Simultaneously, they are offloading over $500 billion of U.S. treasuries, signaling a strategic rotation from dollar assets to gold. The second phase, spanning mid-2025 to 2026, will witness the official unveiling of the new gold-backed currency by the BRICS alliance. This announcement is expected at a summit, likely in June or August of 2025, where member nations will reveal they've collectively deposited thousands of tons of gold into a reserve, backing a new trade currency. This currency will be used immediately for international transactions among BRICS countries. Initially, adoption will be cautious, limited bilateral deals involving oil and commodities. Yet once the infrastructure develops, adoption will accelerate. Countries that resent U.S. dollar dominance, such as Iran, Venezuela, and Syria, will be eager to switch. Neutral nations, like Malaysia, Indonesia, Thailand, and Turkey, who previously depended on the dollar, will now see alternatives. Over the following year or two, up to 30% of global trade could shift away from dollar settlement, drastically reducing demand for the dollar and triggering its decline. In the third phase, from 2027 to 2028, a global financial crisis will tighten. The U.S. may respond with a dramatic revaluation of gold, effectively devaluing the dollar, similar to what happened in the 1930s, by drastically raising gold's official price, perhaps from around $2,200 per ounce to $20,000 or more. This move would make U.S. debt, currently standing at $37 trillion, appear significantly reduced in real terms, as the dollar's purchasing power erodes. The dollar holders would suffer profound losses, while nations that accumulated gold at low prices would see their reserves multiply in value, capturing enormous gains. This process isn't hypothetical. Historically, similar revaluations in 1933 rescued the U.S. economy from crushing debt by devaluing the dollar and inflating away obligations. Today, central banks are applying the same playbook, preparing to revalue gold and reset the monetary system. Why gold? Because it is immune to counterparty risk. No government, company, or hacker can electronically destroy or confiscate physical gold. It remains universally accepted, fungible across borders, and outside the reach of cyber attacks or political manipulation. During systemic crises, gold's security, sovereignty, and neutrality make it the ultimate reserve asset, especially as digital assets become increasingly vulnerable. With government debt soaring and money printing spiraling, inflation is inevitable. Gold is historically the only asset that preserves wealth through inflationary chaos, whether in hyperinflations like 2023 Zimbabwe or the dollar's collapse during the 1930s. The timeline is clear. The initial buildup of gold reserves is happening now, from 2024 through mid-25. Central banks are acquiring gold aggressively, using multiple channels, before the anticipated revaluation. This year alone, they are spending roughly $86 billion annually, selling off dollar assets in lockstep. Come mid-25 to 26, the official launch of the BRICS gold-backed currency will catalyze a fundamental shift, reducing dollar reliance globally and prompting a devaluation of the dollar itself. When the U.S. finally responds with a gold revaluation, perhaps around $20,000 per ounce, the value of gold reserves will skyrocket, while dollar assets will plunge in worth. This historic wealth transfer will be swift and profound, transferring trillions from dollar holders to gold owners, especially in nations outside the West, which are positioning themselves now. The question is whether you will recognize the signs early enough to preserve your wealth, or wait until the chaos is unavoidable. Because the window to act is closing rapidly, strategic and institutional investors are already in motion. The crucial question is whether you will follow the lead of those with the best intelligence, central banks that are buying gold at levels not seen in 73 years, or be left behind as the system resets. The time to position is now. As the dollar's value wanes and inflation surges, the Federal Reserve and Treasury launch a strategic revaluation of gold. They publicly declare a return to gold backing, adjusting the official gold price from a modest $42.22 per ounce to $20,000 per ounce. This maneuver creates the false appearance that the United States holds vast reserves supporting the dollar, but in reality, it results in an approximately 87% devaluation of the dollar relative to gold. Consequently, savings held in dollars hemorrhage purchasing power, bonds turn virtually worthless, and retirement accounts diminish or vanish altogether. Meanwhile, countries like China and Russia, who acquired gold at around $2,000 per ounce, see their reserves balloon in value, with gold holdings now worth over 10 times what they paid. China's unreported gold purchases, totaling around 2,000 tons, translate from about $5.4 billion to roughly $129 billion at the new valuation. Russia's reserves leap from $63 billion to over $1.2 trillion. These nations have effectively earned hundreds of billions through strategic positioning ahead of the revaluation. In contrast, nations that rely solely on dollar holdings suffer catastrophic losses, exemplifying a profound wealth transfer from dollar-dependent entities, particularly Western savers and investors, to countries acquiring tangible assets like gold. This pattern echoes what occurred in 1933 and is anticipated to unfold again in 2027. The crucial question is, which side will you choose? Why? Then, do central banks focus on gold rather than stocks, real estate, cryptocurrencies, or foreign currencies? The answer lies in gold's unique qualities. First and foremost, gold bears no counterparty risk. Unlike U.S. Treasuries dependent on government repayment, stocks reliant on a company's performance, or real estate governed by legal systems, gold's value is intrinsic. No government can print more gold, no corporation can make it vanish through bankruptcy, and no court can invalidate your ownership. Physical gold cannot be hacked, frozen, or confiscated. It's a tangible asset that exists independently of any institution or digital infrastructure. For central banks navigating geopolitical tensions and the threat of sanctions, this makes gold an unrivaled safe haven. Russia learned this the hard way when Western nations froze their dollar assets, and China is aware that its $1 trillion in U.S. treasuries could be seized during a Taiwan conflict. In contrast, gold stored in vaults in Beijing, Moscow, or Delhi remains entirely outside Western control, untouchable, unfreezable, and unconfiscatable. This resilience underscores gold's role as the ultimate shield in a climate of geopolitical uncertainty and economic upheaval. Not for its price gains alone, but for its unmatched security and sovereignty. Gold remains universally accepted. If Russia wants to trade with China but China refuses rubles, they settle in gold. Similarly, If India trades with Iran but Iran rejects rupees, gold is used as the medium of exchange. It's fungible across borders. 1 ounce in Canada, South Africa, or Russia is indistinguishable from another. With no sanctions on gold and no way to embargo it, this metal stands as the ultimate neutral reserve, untouchable by politics. For 5,000 years, that's been gold's enduring role as money. That's why, faced with an uncertain financial future and fractured geopolitical alliances, central banks are returning to gold. It remains the one asset universally trusted and accepted, true global money. Third, gold cannot be hacked or digitally stolen. As the world leans further into digital currencies and cyber warfare escalates, central banks recognize the vulnerabilities of digital assets. In 2022, North Korean hackers made off with $600 million worth of cryptocurrency from Axiom Infinity. The following year, over $2 billion was stolen from various crypto exchanges and DeFi platforms. Digital assets are vulnerable. Wire transfers can be intercepted, accounts frozen with a keystroke. But physical gold stored in vaults with armed guards, multiple security layers, and strict protocols cannot be digitally attacked. It requires infiltrating, overpowering security, moving tons of metal, and escaping, an exponentially harder feat than hacking a computer system or freezing an account. That's why central banks are buying gold to prepare for a world where cyber threats are ongoing and digital assets are persistently targeted. Gold isn't susceptible to hacking or online manipulation. It's the ultimate physical asset in a digital age. Fourth, gold maintains its value against inflation. This feature is vital for central banks today, who anticipate rising inflation. With burdensome debts totaling $37 trillion and a surge of 40% in currency printing over just 2 years, inflation's inevitability is clear. Bonds are decimated by inflation, real yields go negative, and purchasing power erodes. Cash holdings shrink, and stocks falter during inflationary surges. During the 1970s, stocks stagnated in nominal terms, but declined 50% in real value. Meanwhile, gold surged from $35 an ounce in 1971, when Nixon severed the dollar's gold link, to around $850 in 1980, delivering a 24-fold return, preserving and multiplying wealth amid the inflation chaos. Central banks are purchasing gold now because they see the 2020s heading toward a similar, if not harsher, inflationary landscape, fueled by higher debts, relentless money printing, and escalating price rises. Now, consider what this means for you. The most astute, the central banks backed by trillions and staffed with expert economists, are accumulating gold. Their actions signal an impending shift, one you need to prepare for. The key question is whether you will follow the lead of the central banks or ignore their signals and face destruction. When central banks begin accumulating gold, it's a sign you should have already acted, preferably 5 years prior. By the time their buying becomes public, you might be late to the initial phase, but still early enough for the main move. For instance, in 2020, gold was trading at around $1,800 an ounce. Today, in 2024, it's approximately $2,700, a 50% increase. Those central banks that began buying in 2020 already enjoyed a 50% gain. If you decide to purchase gold now at that price, you're doing so at a point where they were accumulating 2 years ago, making you somewhat late to the bottom, but not to the upcoming surge. The crucial factor is what happens next. If gold surges to $20,000 by 2027, a purchase at $2,700 could yield a stunning 7.4 times return in just 3 years. Conversely, if gold remains stagnant at that level for 5 more years, your opportunity could be lost. Your current investment decision hinges on the belief that central banks possess secret information, advanced intelligence, economic insights, and geopolitical intelligence that give them an advantage over the general public. Their track record of strategic moves supports this confidence. They don't make decisions worth $86 billion annually on a whim. They act based on carefully analyzed data. Historically, following their lead has proven to be a wise strategy. To grasp where the market stands, consider the 3 distinct phases of capital migration. The first phase involves smart money, central banks, sovereign wealth funds, billionaires, and ultra-high net worth family offices, which quietly accumulate assets without publicity. The The second phase is institutional. Hedge funds, pension funds, endowments, and large asset managers step in once the trend becomes undeniable, prompted by published data showing central banks' sizable purchases. This is the stage we're approaching now, late 2024 into 2025, where influential voices like hedge fund managers highlight gold as a key asset. This institutional wave will likely push gold from its current level of about $2,700 to perhaps $6,000. When that happens, it will mark a significant escalation in the market's movement. Finally, the third phase is retail panic. Ordinary investors, witnessing the spike from $2,700 to perhaps $6,000, will frantically jump into gold, driven by FOMO, fear of missing out. This phase triggers a mania that propels gold prices to $15,000 or even $20,000, with everyone rushing to buy, creating a spectacular blow-off top. Acting now places you in the early institutional stage, a strategic position before the masses flood in. The decision to buy is rooted in the understanding that central banks possess intelligence and foresight that you and I do not, making their moves a reliable indicator of the coming shift. Seize this moment before the final surge begins. This is the moment to consider taking some profits, as retail panic often signals the final phase of a rally. After that frenzy, the market typically reverts to reality. The revaluation process has concluded, and gold has settled at a new, higher plateau, though its ascent begins to slow. We're not yet in the final stage, phase 3, but instead transitioning from phase 1 to phase 2. The savvy investors, smart money, have already begun accumulating, and institutional players are starting to buy in. Yet, most retail investors remain unaware. If you position yourself now, you're ahead of the crowd. Early institutional, though not among the earliest, but certainly not late either. You're precisely where you should be. The recommended strategy is to allocate between 10 and 20% of your liquid net worth in gold, excluding your residence or vehicle, focusing solely on your readily investable assets. For a $100,000 portfolio, this equates to $10,000 to $20,000 in gold. Within that allocation, allocate approximately 70% to physical gold, 1-ounce coins or bars from reputable sources such as American Gold Eagles, Canadian Maple Leafs, Austrian Philharmonics, or recognized refiners like Pamp Suisse or Credit Suisse. Avoid numismatic coins or collectibles, buy bullion based on weight and value only. Store your physical gold securely, either in a safe at home if you have proper security measures or in a private vault. Do not keep it in a bank safe deposit box, as banks can be closed during crises by government decree. Trusted private vault services like Brinks, Loomis, or allocated storage at reputable dealers are ideal. This physical gold acts as your insurance. If the system collapses, the dollar is devalued, or there's a bank holiday, you will have tangible metal to hold and trade. The second component of your portfolio should be about 20% in gold ETFs such as GLD or IU in the United States. These are paper-backed gold funds held by vaults, liquid, easily tradable, and suitable for retirement accounts where physical gold isn't permitted. However, they carry counterparty risk. They depend on the ETF structure and the custodian's integrity. In a true crisis, ETFs could fail, or the government might seize the underlying gold. Nonetheless, for most retirement portfolios, ETFs remain the most practical option. The final 20% should be in gold mining stocks, companies like Barrick Gold, Newmont, Franco-Nevada, or Wheaton Precious Metals. These stocks tend to amplify gold's price movements, often rising by 2 to 3 times in percentage terms. If gold climbs 50%, mining equities could double or even triple those gains. But these are stocks. They are more volatile and susceptible to operational risks or broader market downturns. Use this portion as your speculative, high-upside bet. Now, addressing common concerns, some may worry that the government could confiscate gold again, as it did in 1933. However, that scenario seems unlikely today. Back then, the dollar was backed by gold, and government action was motivated by the need to bolster the currency or control the money supply. Today, the dollar operates as a fiat currency, unbacked by gold or any tangible reserve. The government does not need your gold to sustain or back the currency, and the legal and logistical hurdles to confiscation have significantly increased since last century. In the 1930s, widespread gold ownership made such measures feasible, but now, less than 2% of Americans hold physical gold, making mass confiscation impractical and unlikely. Additionally, gold can be stored in countries beyond U.S. jurisdiction, transferred across borders, and remains outside the reach of any single government's authority, especially if kept in secure, private vaults overseas. Enforcing confiscation in today's interconnected, digital world would be overwhelmingly difficult and politically perilous. Therefore, the more probable move by authorities is a strategic rebasing or revaluation of existing reserves, raising the official gold price to devalue the currency. That benefits those who own physical gold and allows governments to reduce their debt burdens indirectly. This approach would give early movers a substantial advantage without the upheaval and resistance associated with outright confiscation. In summary, the best way to prepare for the unfolding economic transformation is to hold physical gold, diversify with ETFs and miners, and stay alert to developments signaling the systemic shift. Being proactive now can help safeguard your wealth against the upcoming reset, as history demonstrates that gold preserves and enhances value across crises. And remember, if this perspective resonated with you, please subscribe for more insights on how to navigate these extraordinary times. Once widely used as everyday currency, millions of Americans once kept gold coins in their pockets. Today, fewer than 2% of Americans own physical gold, a negligible fraction of national wealth. Any attempt at confiscation would yield minimal gain for the government because the smaller the holding, the less impact it has on their debt load. Moreover, enforcing such a measure today would be virtually impossible. In the past, in 1933, transactions were entirely physical and localized, making confiscation straightforward. Now, gold is traded globally, stored in multiple countries, and can be transferred across borders with ease. Implementing an effective, worldwide clampdown would require unprecedented international cooperation and mass surveillance, an unrealistic scenario. Instead, the more plausible approach is what has been outlined. The government revalues its existing gold reserves to reduce the debt burden. Private gold owners benefit too, as the market adjusts the metal's value accordingly. If gold jumps from around $2,700 to $20,000 per ounce, both government reserves and private holdings stand to profit. Meanwhile, the dollar's value would plummet under the weight of inflation, effectively eroding your cash and savings. The true cost of this strategy. Could officials attempt confiscation anyway? Perhaps, but even if they did, months or years of warning would give asset owners time to move assets elsewhere. The political backlash against such a move would be immense, making outright confiscation highly unlikely. Instead, it's far more probable that authorities quietly revalue gold and allow market forces to carry the adjustment. Now, some argue that gold doesn't produce dividends or interest, so holding it involves opportunity costs. That's true. Gold is fundamentally a store of value rather than an income-generating asset. But during systemic resets, income assets, bonds, dividend stocks, real estate in certain markets often falter or become illiquid. Bonds can default or be inflated away. Stocks may cut dividends or fail. Property in unstable regions can lose value or become difficult to sell. Gold, on the other hand, remains a risk-free haven, absent of credit risk, geopolitical risk, or market failure, offering protection against chaos. Moreover, if gold's price surges from roughly $2,700 to $20,000, the capital appreciation vastly outweighs any income you might have missed out on. Some may ask why not just buy Bitcoin, often called digital gold. Bitcoin does have merits, scarcity, portability, programmability, but central banks aren't buying it in significant amounts. Over the past 2 years, China acquired 300 tons of gold, not Bitcoin. Russia bought 330 tons, again, not Bitcoin. The reason is historical. Gold's 5,000-year legacy as the ultimate store of value surpasses Bitcoin's 15 years. It has survived every empire collapse, currency crisis, and war. Bitcoin remains untested in a true global systemic crisis, and its treatment by governments in such scenarios remains uncertain. Will nations ban, confiscate, or heavily tax Bitcoin? We simply don't know. But gold's durability and proven resilience make it the preferred choice for central banks managing trillions in reserves. Having some Bitcoin exposure, say, about 5% of your portfolio, is a reasonable speculative bet. But your core hedge against dollar collapse should be gold. That's the message central banks are sending. Hashtag the action plan. Start by determining what percentage of your liquid assets you're willing to allocate to gold, ideally between 10 and 20%. For a $100,000 portfolio, that means investing $10,000 to $20,000 in gold. Within that allocation, focus primarily on physical gold, 1-ounce coins or bars from reputable sources like American Eagle, Canadian Maple Leaf, or Austrian Philharmonic. Avoid numismatic coins or collectibles. Buy bullion based on weight and market value. Store your physical gold securely, preferably in a private vault or safe at home if you have proper security, rather than in bank safes, which could be temporarily closed during crises. Additionally, consider holding gold ETFs, such as GLD or IU, held in retirement accounts that restrict physical possession. These offer liquidity but come with counterparty risks, meaning they depend on the trustworthiness of the custodian and whether they truly hold the physical gold. For higher risk and potential upside, allocate around 10% of your assets to gold mining stocks. They leverage gold's price movements, but can be more volatile. Hashtag preparing for the next phase. Immediate steps include researching reputable gold dealers like APMEX, JM Bullion, or Money Metals Exchange, and establishing accounts. Begin purchasing physical gold gradually, starting with a few ounces, without overly trying to time the market. Over the coming months, systematically dollar cost average into your holdings. Buy more when prices dip, less when they rise, until you reach your target allocation by mid-2025. Stay vigilant for early signals of broader systemic shifts, announcements of gold-backed currencies by BRICS nations, trade agreements in non-dollar currencies, or sizable central bank gold buys. A sustained breakout above $3,000 per ounce may indicate the beginning of institutional participation. When gold hits around $4,000, the move quickens. At $6,000, retail panic may set in. By 2027, the objective is to be fully positioned, holding stored physical gold, ETFs, and gold stocks, ready for the anticipated revaluation. When governments declare a return to gold backing and adjust official reserves to $20,000 per ounce, your wealth could multiply several times over, while those clinging solely to dollars would suffer devastating losses. The final insight. Recent reports from the Bank for International Settlements confirm that central banks are actively accumulating gold as part of their preparations for a potential disconnect from dollar dominance and a revamped global monetary system. They see the writing on the wall, the shift to a new reserve currency backed by gold, possibly occurring in 2025 or 2026. The question isn't if the dollar will eventually collapse and gold will be revalued. History and current policies make that clear. The real question is whether you will position yourself before it happens or wait until it's too late. If this message resonates, consider acting now. Your financial future depends on it. The window to prepare is rapidly closing. Once the revaluation occurs, reversing course will be impossible. Safeguard your wealth by aligning with the central bank strategy. Buy gold now and hold it through the coming upheaval. Here's a refined and condensed version of your message. This week, determine your gold allocation. Review your liquid net worth and assign 10 to 20% for gold holdings. Open accounts with reputable dealers, such as APMEX, JM Bullion, SD Bullion, or Money Metals Exchange, researching their prices, shipping, and storage options. If you lack a brokerage account, set one up for gold ETFs. Within this month, make your initial purchase. Start with 2 to 5 ounces of physical gold based on your target. Don't attempt perfect timing. Simply begin accumulating. If you can't hold physical gold in your IRA or 401k, add gold ETFs to reach a 5 to 10% allocation immediately. Over the next 3 months, adopt a dollar cost averaging approach. Buy more gold each month. More when prices dip to $2,500, less when they rise to $2,900. Persistently grow your holdings toward your 10 to 20% goal by mid-2025, then hold. Stay alert for catalysts. Breakthrough BRICS announcements in 2025, trade agreements outside the dollar, additional central bank gold purchases, or discussions by governments about gold backing or strategic reserves. These signals confirm the timeline. Monitor gold's price movements closely. If it surpasses $3,000 and stabilizes, the second institutional phase begins. At 4,000, that momentum accelerates. At 6,000, retail panic likely triggers. By 2027, aim to be fully positioned and holding. Anticipate the revaluation or official announcement of gold at $20,000 per ounce, which could multiply your gold holdings by 7 times or more. Meanwhile, those holding dollars risk losing 80 to 90% of their purchasing power. Positioning now with central banks ensures you survive the inevitable reset. Recent revelations from the September 2024 report by the Bank for International Settlements, the central bank of central banks, underline this trajectory. Not a conspiracy theory, but an admission. Central banks are actively buying gold in anticipation of de-dollarization and fundamental systemic changes. The dollar's reserve status is vanishing as the global financial landscape shifts. Preparing with gold is the strategic move. The question is whether you'll follow suit or be left behind. Central banks are actively accumulating gold. This is not a conspiracy, but an openly documented strategy by the world's highest financial authorities. Over the past 2 years, they have purchased more than 2,000 tons of gold, the highest level since 1950. In 2024 alone, they plan to add another 1,000 tons, totaling 3,000 tons in just 3 years. With gold priced around $2,700 an ounce, this amounts to roughly $260 billion, $250 billion, a level of investment far beyond ordinary diversification. This isn't random. It's preparation for a specific event. The impending collapse of the dollar, a revaluation of gold, and the reset of the global monetary system loom on the horizon. These decisions are driven by intelligence far beyond public knowledge. They see what's coming, something you might not, and are positioning accordingly, because in currency collapses, gold is historically the only asset that endures. Always. Without exception, across human history. The fundamental question isn't whether the dollar will fall or gold will be revalued. It's whether you will position yourself before the inevitable or be left behind. Acting now means preserving and even growing your wealth. Waiting means risking total loss. Central banks have committed to gold at levels unseen in 73 years, and it's time for you to make your choice. Follow their lead or ignore the warning at your peril. The window of opportunity is narrowing, with the revaluation expected between 2025 and 2027. Once gold officially hits $20,000 an ounce and the dollar collapses, inflation erodes savings beyond recovery. It will be too late to undo the damage, and the wealth stolen by devaluation will be lost forever. You can only position yourself now, before it's too late. If this message reveals what central banks understand but the public does not, then act. Over the coming 18 months, I will continue to monitor every gold purchase by central banks, every announcement from BRICS, every move toward a gold-backed currency, every sign of dollar's decline and gold's revaluation. Watching month by month and quarter by quarter is the key to avoiding being blindsided. Because the difference between foresight and being caught off guard is the difference between wealth preservation and total loss. Central banks are preparing 3,000 tons of gold in just 3 years, the largest accumulation in nearly 3 generations. They know what's coming. Now you do too. The only question remaining is whether you will act. Your future depends on the choice you make. Choose wisely.